this is going to drastically change forward earnings estimates for companies. And this is the one thing we've talked about quite a bit. Forward earnings estimates have been very elevated, and that those were going to have to come down. Well, this will do that. This is what you need to know before the bell this morning. It's going to be a little bit long. First of all, as we had talked about, that this increases dramatically the U.S. tariff rate. The increase in the tariff rate under these new parameters. So, for instance, these tariffs are stacked. Like, for instance, in the case of China, he announced a 30% increase on China in terms of the tariffs, but you have to stack that with the other 20% that he had already put on China. So that's a stacked tariff. So the actual tariff on China is 54% altogether. But this leads up to the highest tariff rate we've had in 125 years. So it's been a very sharp increase. Now, that's going to have to be dealt with by both U.S. manufacturers as well as potentially consumers. The question, as we've talked about before, is whether or not the tariffs can be passed on to the consumer. But this does increase costs. So this is going to drastically change forward earnings estimates for companies. And this is the one thing that we've talked about quite a bit, is that forward earnings estimates have been very elevated, and that those were going to have to come down. Well, this will do that. And so when we start talking about forward earnings estimates, which is all that matters for markets, again, as we've talked about before, you can put all the narratives up that you want, but at the end of the day, what is it that markets are looking at? They price on what future expectations are going to be. Goldman Sachs came out with a range of estimates. And so when you kind of look at this table, you can kind of start running the gamut. If earnings decline, and currently right now estimates are, running at, according to Goldman Sachs, at 269. According to S&P, they're up around 270 at the moment, so close. And so if we start ratcheting those down on the basis of these tariffs, that's going to reduce the upside for the market. So currently we're running at about 22 times forward earnings. So at a reduction to, let's just use worst case scenario, we reduce earnings down to $220 a share. That brings the markets down to about $48.50. So that's some decent outside at $2,200. But again, this is the worst case scenario for this. So there is downside to the markets. Even in historically going back to the turn of the century, the market tends to trade between 18 and about 20 times earnings. So you can kind of run the gamut somewhere between 3,950 to 5,400 based on those estimates. Well, what that suggests is, and something that we've talked about several times this year so far, is that doesn't leave a lot of upside to the markets this year. Lots of volatility, lots of trading ranges potentially, but not a lot of upside. And as we've said earlier, we may have seen the upside for this year already. So this is what markets are going to have to deal with, though, is trying to figure this out. Now, there is some good news to this, which is that these are kind of the worst case scenarios in terms of the expectation of what the tariffs were going to be. So that's the bad. The bad news is very, very elevated levels of tariffs. The good news is that these were worse than expected tariffs, right? So now any relitigation of these tariffs by the Trump administration, if countries come back to the table and say, hey, we want to, we'll reduce our tariffs if you'll reduce your tariffs, and we start reducing those tariffs, that does provide some upside for the market. So the good news is from this is that the relitigation of these tariffs over the course of the next 6-8 months, as we kind of go forward, is going to potentially provide some benefit to the markets, because then those estimates will start to come up. So again, yes, very shocking news yesterday, worse than expected, and the markets are responding to that this morning. Markets going to be down 3.5% at the open this morning. So expect a knee-jerk sell-off. I would be reticent to sell into this sell-off this morning. typically markets tend to react the worst and kind of on the news, and then markets kind of rethink things once markets kind of get opened and underway. So to be a little bit cautious about knee-jerk reactions this morning relative to the market or making any type of big decisions. But let's look at some charts here real quick, just on the S&P. I had laid out this chart for you a couple of days ago showing these Fibonacci retracements. We're going to be testing that kind of that 36.3% retracements. That's that next level of support. We're going to take out the recent lows this morning. We'll see how the market responds at this point, and where we close will be very, very important today. But we are going to be testing support that goes back to last year, and the market should try to find some support at this level. But again, there's some good news, bad news. First of all, the bad news is that we are taking out the recent levels of support. The good news, if you want to kind of put it that way, is that the markets are already oversold. The good news here is that we're not starting from overbought conditions. This news just hit, and markets are having to rapidly reprice everything from a very overbought condition. We've already been in a correction now for the last month. We've already worked through a lot of this repricing in the markets already. And so we're getting to levels where even with this decline today, we may find buyers coming into the market. So that's why I'm saying be a little bit cautious about knee-jerk reactions here. Bonds are going to perform well today on this news. That'll help hedge portfolios as well, limit some of the downside. But again, companies, and particularly that deal a lot with China, are going to be hit today. Apple, Microsoft, NVIDIA, Google, the Mag 7 are going to be down. 42% of their revenues come from overseas. They're going to be hit. So the S&P itself is going to be hit by this impact of foreign tariffs on markets. That's what you need to know before the bell this morning.